good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, we're at the halfway mark of what has so far been a pretty painful year for investors in 2022, and that has not really been restricted to just one single asset class. Equities and bonds have taken a beating so far in the first 6 months of the year. Today, we're going to focus on equity markets, in particular, the local and international level. We're going to take a look at what would have occurred and what investors might expect in the coming months ahead for stocks at the local and international level. Turning firstly to our local markets, and the Trinidad and Tobago Composite Index in that blue line has declined just around 7.7% for the 6 month period ended June 30th, the halfway mark, of course, and that has been a pretty steady decline, as we can see, as the audience can see, declining in a pretty much consistent manner over the first 6 months of the year, and that has really been contributed to significantly by a decline in the cross-listed index in green, down just around 21.5% for that 6 month period as well. Locally based companies, as measured by the All TNT or All Trinidad and Tobago Index, have held their own fairly well, down just 2.4%. Now, when we take a look at the major movers in terms of best performers and, well, worst performers on the composite index, it has been very stark differences in performance. At the top of the queue, Agostini's Limited is up 42.3% on account of continued acquisition activities and continuing growth. Angostura also has been improving, up 27.2%, with fairly resilient demand for its products and services. Scotiabank up 12.2%, offering investors a fairly robust dividend yield. Deco and TCL, some of the smaller cap stocks on the Trinidad and Tobago Stock Exchange, up just marginally, 7.9 and 3.4% respectively. On the other end of the curve, however, some fairly large cap and heavyweights on the index have suffered major declines. NCBFG, one of the largest regional banking institutions or financial services groups in the region, down 31.5%. First Citizen Group Financial Holdings, who is currently in the midst of an additional public offering, its second additional public offering, down just around 20%. First Caribbean International Bank down just around 18.6%. Whitco, the traditional high dividend yielder, down 18%, and Unilever Caribbean, on account of reductions in operations and divestments, down just around 14.3% year to date. So very stark differences from the worst and best performers year to date on the local exchange. And at the international level, well, when we take a look at the S&P 500, for example, the S&P 500 actually closed the half-year point in bear market territory, down 20.6%, and it has been broad-based, fairly unwelcome reading for investors, with pretty much every sector in the red, with the exception of energy markets up. The energy sector has been up just about 28.8% of the S&P, that is, year to date, and that has really been driven by severe disruptions in energy markets attributable to, one, supply chain disruptions, and two, the ongoing Ukraine-Russia standoff, which does not seem to have any end in the very near future. At the other end of the spectrum, consumer discretionary section was down 52.8%, and this signals to investors and the wider market that there are major concerns about spending power of the consumer in the midst of a very high inflationary environment. When we take a look at international markets, otherwise, other regions would not have fared any better. Europe has been down 16.7% at the half-year mark, Asia down 16.8%, and Latin America, with some fairly significant commodity export based countries, down just about 4.2%, but pretty much in the negative for all of the major investing regions in 2022 at the half-year mark. Now, what can investors expect in the coming months ahead? Well, at the domestic level, there is that prospect of economic recovery as the economy continues to slowly but surely reopen, and in mid-July, the mask-wearing mandate is expected to be rolled back in most circumstances and move to being optional, and that is a signal of intent for continued reopening of the domestic economy. Inflationary pressures are going to continue, with much of our inflation and goods and services imported for consumption in the Trinidad and Tobago economy. Robust energy markets should help the government fiscal position in this fiscal year, with much better or much improved pricing for energy and energy commodities, notwithstanding a fairly muted impact in terms of improving production on the domestic front. And with those inflationary pressures, we can expect some measure of weaker consumer demand. Of course, fuel prices would have increased recently, and there is the prospect of rising food prices also. At the international level, much of the same elevated inflation is going to weigh on the consumer, and that uh, that feature or phenomenon is being met with rising interest rates by central banks who are struggling to combat and contain inflation at the global level. This has been exacerbated by supply chain constraints and, of course, those ongoing geopolitical tensions, which leaves a very uncertain outlook for equity market investors in the coming months. So, what can you, as a stock market or equity investor, do in the coming months? Well, if you are on the end of being lower risk as an investor, you may want to consider rotating out of some of your equity positions given the continuing uncertainty, and look at some cash or near cash instruments or solutions to insulate your portfolio a bit, such as income mutual funds or repurchase agreements, deposits at banks or banking type institutions as well. For the moderate risk investor, this may be an opportunity to simply or increase your or restore your exposure to your equity allocation in your portfolio, but consider sector and asset diversification with highly diversified exchange traded funds, etc. And of course, just bear with volatility. Investing is a marathon, not a sprint. So this may be an opportunity to basically make some small adjustments to your portfolio. And for the higher risk investor who does like to dabble in stocks, well, this might be one of those buying opportunities of a generation. And if you are focusing on long-term growth, you can consider this an opportunity to pursue some buying opportunities and focus on quality, less of the speculative stocks, more of the high value stocks, perhaps with generous dividends or industry leaders. But that's it for this week's edition of the Bourse Report. For more information, you can give us a call at 226-8773, email us at invest@boursefinancial.com, or check out our website where all of our research is absolutely free at bourseinvestment.com. Until next time, stay safe, and we'll see you at the next edition of the Bourse Report.